Falling three methods pattern is recognized as a bearish continuation pattern in the world of trading. It is indicative that the current downtrend is likely to continue. This pattern is distinguished by a long bearish candle, followed by three smaller bullish or bearish candles within the range of the first candle, and concludes with another long bearish candle that closes lower than the second candle's close. Understanding and identifying the falling three methods pattern is crucial for traders as it signals potential opportunities to enter the market with a short position or to hold off on making purchases in anticipation of further price decreases. It emphasizes the underlying strength of the bearish market trend and suggests that the sellers are still in control after a brief pause. It is encouraged for traders to practice recognizing this pattern as part of their technical analysis toolkit. By applying it in various market conditions, traders can refine their ability to forecast market movement, make well-informed decisions, and develop strategies that align with the ongoing trends. Lastly, a note on the dynamic nature of trading highlights the importance of continuous learning and adaptability. As markets evolve, traders should remain open to enhancing their understanding of technical patterns and adapting their strategies to meet the current market conditions. Mastery of technical analysis, including patterns like the falling three methods, supports better decision-making and can potentially lead to improved trading outcomes. Candlestick patterns are a fundamental component of technical analysis in the financial markets. They serve as a visual representation of market sentiment and price movements, encapsulating the open, high, low, and close prices within specific time frames. Traders and investors scrutinize these patterns to predict future market movements and make informed decisions. Among the myriad of patterns, the deliberation pattern stands out as a significant indicator of a possible shift in market direction. The deliberation pattern is characterized by three consecutive long-bodied candles, with each successive candle opening within the real body of the previous one. This sequence typically emerges in the context of a prevailing bullish trend, indicating a robust upward price movement. However, the crucial aspect of the deliberation pattern is its third candle, which, unlike its predecessors, is a small-bodied candle or a doji, a candle with virtually no difference between its opening and closing prices. This final candle suggests a weakening in buying pressure and a potential hesitation among bulls, which can signal the onset of a bearish reversal. In essence, the presence of the deliberation pattern signals to traders and investors that the current bullish momentum may be losing strength, and a change in trend could be imminent. Recognizing this pattern enables market participants to adjust their strategies accordingly, potentially taking preventive measures to protect profits or prepare for a bearish market environment. Understanding and identifying candlestick patterns like deliberation is vital for navigating the complexities of the financial markets. It equips traders with a tool for deciphering market psychology and adapting to ever-changing market conditions. The deliberation candlestick pattern is a configuration seen on price charts, often identified as an indicator of potential reversal from a bullish trend to bearish momentum. It consists of three candles in a specific sequence. The first two candles are large and white, showing a strong bullish sentiment as prices have closed significantly higher than they opened. The third candle, however, is much smaller and may be white or black, indicating a decrease in buying power and an increasing level of indecision among traders. To visualize the deliberation pattern without using images, imagine you are looking at a price chart. For the first two sessions, you see two long and upward moving candles, one following the other, closing near their highs well above their opening prices. These candles represent a strong buying interest and confidence among the participants. However, in the next session, you witness a much smaller candle. Its color is not as important as its size, which is significantly smaller than the preceding ones. This small candle suggests that the upward momentum is waning, and the buyers are no longer aggressively pushing the price higher. The presence of the deliberation pattern is crucial for traders and analysts, as it suggests a cooling off period where the previous bullish strength is questioned and the market is indecisive. It does not guarantee a reversal, but hints that the bullish trend could be running out of steam, and a bearish movement may be on the horizon. Traders might use this pattern in conjunction with other analysis tools to make informed decisions about entering or exiting positions, always bearing in mind the need for further confirmation of trend reversal through additional price action or indicators. The deliberation pattern in technical analysis is identified by its unique shape, size, color, and the sequence of the candles. It usually appears at the end of an uptrend and consists of 3 consecutive candlesticks. The first 2 are large and white, showing a continuation of the buying pressure, while the third is smaller and may be black or white, indicating a slowdown in momentum and reflecting uncertainty among traders about the future direction of the market. The shape and size of the candles are critical. The first 2 candles should show a significant and robust movement upward, evident in their large bodies. The third candle is noticeably smaller, and its color is less important than its size, which reveals the trader's hesitation. The sequence is equally important, with the pattern starting with 2 strong bullish candles, followed by a smaller, indecisive candle. This specific order is what signals a potential shift from a bullish to a bearish market sentiment. The importance of the pattern's position within an uptrend cannot be overstated. For an accurate interpretation, the deliberation pattern should emerge after a clear and sustained uptrend. This positioning is crucial because it highlights the change in market psychology from a strong conviction in continued upward movement to uncertainty and indecision. Therefore, traders and analysts pay close attention to its emergence as an early indication of a potential reversal in trend. Visual examples from different market conditions can significantly enhance understanding. Imagine observing a stock chart after a prolonged upward trend. As the uptrend matures, you notice the formation of 2 large, white candles indicative of strong buying interest, followed by a much smaller candle. The contrast between the large bodies of the first 2 candles and the small body of the third is stark, underscoring the declining buying pressure and rising indecision among market participants. By analyzing real examples across various markets, traders can better recognize the deliberation pattern and make more informed decisions regarding their positions in anticipation of potential reversals in the market trend. The deliberation pattern in market analysis is a significant indicator of a potential shift in the market sentiment from bullish to bearish, reflecting a moment of indecision among traders. This pattern typically appears at the end of an upward trend when the market experiences 3 consecutive candlesticks. The first 2 being long and white, indicating strong buying pressure, while the third is significantly smaller, suggesting a slowdown in buying momentum. The presence of the deliberation pattern suggests that traders are becoming uncertain about the market's ability to continue moving upward. This moment of hesitation is critical as it can lead to a trend reversal. The first two candlesticks show confidence among traders, pushing the market higher. However, the third candlestick marks a change. It is shorter because the opening and closing prices are closer together, indicating less conviction in the market's direction. It serves as a visual cue that the bullish sentiment is weakening and traders are deliberating their next move, uncertain whether to continue buying at the same pace. This pattern is a reflection of the psychological aspect of trading, as market sentiment is significantly influenced by traders' perceptions and reactions to unfolding events. When the deliberation pattern emerges, it signifies that the previously dominant buyer enthusiasm is waning and caution is setting in. Traders sensing this shift might start selling off their positions to lock in profits, fearing a downward trend could erase their gains. This potential for a sell-off contributes to the bearish reversal risk, as more traders may follow suit, leading to a decline in prices. In summary, the deliberation pattern captures a pivotal moment of psychological shift among traders, highlighting the transition from confidence to caution. This can serve as a valuable insight for those looking to identify potential turning points in the market, as it underlines the importance of trader sentiment and psychology in influencing market direction. Recognizing this pattern helps in forecasting potential reversals, enabling informed decision-making regarding entry or exit points in trading strategies. The deliberation pattern in market analysis is recognized for its potential to signal a bullish to bearish reversal. This pattern typically manifests at the culmination of an uptrend, characterized by a small body candlestick that follows a series of longer ones. Its appearance suggests a slowing momentum and a possible shift in sentiment from buying to selling. Understanding the predictive power of the deliberation pattern involves acknowledging its role as a cautionary signal rather than a definitive indicator of trend change. Its formation alerts traders to a diminishing bullish drive, which could precede a trend reversal. However, its reliability increases when used in conjunction with other analytical tools. This may include volume analysis, where a decrease in trading volume can confirm the weakening of the trend, or when the pattern emerges near resistance levels, reinforcing the reversal likelihood. For a more tangible example, consider a scenario where a stock experiencing a steady uptrend suddenly presents a deliberation pattern. The first two candles are long and green, reflecting strong buying pressure. The third, however, is noticeably shorter, hinting at an emerging indecision among traders. This moment requires careful observation. A subsequent candle closing below the third can confirm the reversal, transforming the deliberation pattern from a potential to an actual reversal signal. The importance of context and additional confirmations cannot be overstated. For instance, a deliberation pattern forming after an extended price increase is more significant than one appearing after a short-lived rally. Similarly, the presence of this pattern near key resistance levels, combined with other indicators such as the relative strength index, RSI showing overbought conditions, elevates its significance. In sum, the deliberation pattern serves as an early warning sign that demands trader vigilance. Confirmation from other sources of technical analysis and an understanding of market context are essential for harnessing its predictive potential. Through this disciplined approach, traders can better navigate the intricacies of market reversals, making informed decisions that align with their strategic objectives. When evaluating the deliberation pattern's implications for a potential bullish to bearish reversal, it's crucial to consider additional indicators and conditions to validate these signals. Trading volume, nearby resistance levels, and the overall market trend are significant factors to examine, as they can either reinforce or weaken the reversal potential indicated by the pattern. Firstly, trading volume serves as a robust indicator of the strength behind a price move. A deliberation pattern accompanied by decreasing trading volume suggests that the bullish momentum is waning, reinforcing the pattern's implication of a potential reversal. Conversely, if trading volumes remain high or increase, it may indicate sustained buyer interest, potentially weakening the case for an immediate reversal. Secondly, nearby resistance levels are critical to consider. If the deliberation pattern occurs near a strong resistance level that has previously capped price advances, this proximity can strengthen the reversal potential. It signals that the market may struggle to push prices above this barrier, supporting the notion of an impending bearish turn. Lastly, the overall market trend plays a significant role. A deliberation pattern found within a broader bearish market context may affirm the likelihood of a reversal, as the existing trend can exert downward pressure on prices. On the other hand, if the overall market trend is bullish, it suggests a strong buying sentiment that might counteract the reversal signal, diminishing its immediate impact. In summary, while the deliberation pattern itself is a critical technical analysis tool indicating a potential bullish to bearish reversal, its efficacy and reliability are significantly enhanced when considered alongside trading volume, nearby resistance levels, and the prevailing market trend. Each of these factors can provide valuable context, enabling a more informed interpretation of the pattern and its implications for future price movements. The deliberation pattern, often observed in financial markets, signals a potential shift from a bullish to a bearish trend. Historically, the accuracy of the deliberation pattern in forecasting trend reversals has been notable but not absolute. It reflects moments of hesitation in market movements, where the momentum of a bullish trend starts to wane, and the potential for reversal becomes apparent. This pattern typically manifests through specific candlestick formations, indicating that buyers are losing control and sellers may be gaining ground. However, it is important to acknowledge the limitations of relying solely on the deliberation pattern for making investment decisions. Like all technical analysis tools, its predictions are not guaranteed. The financial markets are influenced by a myriad of factors, including economic indicators, geopolitical events, and market sentiment, which can all affect the reliability of technical patterns. Therefore, for more reliable predictions, it is crucial to corroborate the deliberation pattern with other analytical tools. This includes integrating both technical analysis, such as moving averages and oscillators, and fundamental analysis, which considers a company's financial health and the broader economic landscape. Using a multifaceted approach allows investors to validate the potential trend reversal signaled by the deliberation pattern and make more informed decisions by considering a broader set of data points and market insights. To effectively combine the deliberation pattern with other technical analysis tools for a comprehensive market analysis, consider the following methods. First, integrating the relative strength index, or RSI, with the deliberation pattern provides a potent way to confirm the weakening momentum associated with this pattern. Specifically, if the deliberation pattern suggests a potential bearish reversal and the RSI is simultaneously showing overbought conditions, typically above the 70 level, it reinforces the likelihood of a downturn. Next, the moving average convergence divergence, or MACD, can be utilized alongside the deliberation pattern to identify shifts in momentum that might not be immediately apparent from price action alone. A declining MACD histogram or a bearish MACD crossover following a deliberation pattern can confirm the bearish reversal signal, providing a more robust basis for making trading decisions. Moreover, Fibonacci retracement levels allow traders to identify potential support and resistance levels following the appearance of a deliberation pattern. If a price reversal occurs and the new trend retraces to significant Fibonacci levels like 61.8% or 38.2%, it might provide strategic entry or exit points aligned with the reversal indicated by the deliberation pattern. Let us delve into a real-world example to highlight how integrating these tools can enhance trading strategies. Imagine a stock demonstrating a clear deliberation pattern after a strong uptrend, suggesting a bearish reversal. Simultaneously, the RSI crosses above 70, indicating the stock is overbought. If the MACD shows a decreasing histogram or a bearish crossover occurs around the same time, it reinforces the reversal signal provided by the deliberation pattern. Traders might then use Fibonacci retracement levels from the start of the uptrend to the peak formed by the deliberation pattern to identify potential support levels where the price might bounce after a retracement. By combining these indicators, traders can make more informed decisions about when to sell the stock before the expected downturn begins or identify optimal re-entry points during the retracement. Through integrating multiple technical analysis tools, traders can validate signals and improve the accuracy of their trade timing, enhancing their overall market analysis and trading strategy. Traders often encounter challenges when analyzing the deliberation pattern, which signals a potential shift from a bullish to bearish market trend. Understanding common errors and misconceptions can greatly improve pattern recognition and analytical skills. One prevalent mistake is over-reliance on this single pattern without considering the broader market context. The deliberation pattern should not be used in isolation. Traders are advised to look at market trends, economic indicators, and other technical analysis tools for a comprehensive view. Another common error is misidentifying the deliberation pattern due to inexperience or lack of attention to detail. This pattern is characterized by 3 consecutive long white or green candlesticks with a third candlestick showing a small body. Misidentification may occur when traders overlook the volume aspect or the preceding market trend, leading to inaccurate interpretations. To avoid these mistakes, traders should focus on enhancing their pattern recognition skills through practice and continuous learning. It is beneficial to study historical charts and identify past occurrences of the deliberation pattern to understand its implications better. Additionally, using stop-loss orders can limit potential losses when a pattern does not lead to the anticipated market movement. Furthermore, traders should cultivate patience and discipline, waiting for additional confirmation signals before making a trade based on this pattern alone. Engaging with a community of traders and sharing insights can also provide valuable perspectives and improve decision-making. In summary, By acknowledging common errors and applying these tips, traders can refine their approach to analyzing the deliberation pattern, contributing to more informed trading decisions and enhancing their overall trading strategy. When employing the deliberation pattern in trading strategies, it is essential to use it as an indicator for setting entry and exit points due to its ability to signal a potential trend reversal from bullish to bearish. The deliberation pattern is identified by 3 consecutive candlesticks, usually at the peak of an uptrend, where the first 2 are long and white, indicating strong buying pressure, but the third is smaller and shows indecision among traders. To effectively use this pattern for trade entries, traders should look for confirmation of the trend reversal following the pattern's appearance. This could be in the form of a bearish candlestick or a gap down the next day, indicating that the bears are taking control. An entry point for a short position could be set just below the low of the third candlestick in the deliberation pattern. Meanwhile, a stop-loss order might be placed above the high of the same candle to manage risk. For exit points, traders could consider setting a target price at a key level of support that the price might fall to if the bearish reversal plays out as anticipated. Alternatively, they might use trailing stop-loss orders to lock in profits as the price moves lower. One effective case study of utilizing the deliberation pattern comes from a trader who observed this formation at the top of a prolonged uptrend in a well-known tech stock. By waiting for additional confirmation of a downtrend the following day, the trader entered a short position shortly after the market opened, capitalizing on the subsequent decline. The trader set an initial profit target at the next significant level of support and used a trailing stop loss to maximize gains as the stock continued to fall, eventually exiting the position with a substantial profit. Such examples illustrate the power of combining the deliberation pattern with careful confirmation and risk management strategies. By doing so, traders can more confidently navigate potential trend reversals, enhancing their ability to make profitable trades. The deliberation pattern in the context of trading is a technical analysis tool that signals a potential shift from a bullish to a bearish market trend. It is characterized by a specific formation on a price chart consisting of 3 consecutive long-bodied candles with closing prices higher than their opening prices, indicating an uptrend. However, the third candle in the sequence shows a smaller body or a doji, a candle with a similar opening and closing price signaling uncertainty and possibly a reversal in market sentiment. Variations of the deliberation pattern share this underlying theme of signaling a potential market reversal, but differ in their formation and specific implications for trading. 2 notable variations include the evening star and the shooting star patterns. The evening star pattern is similar to the deliberation, but is more specific in its formation. It consists of a long bullish candle, followed by a short-bodied candle or a doji that gaps above the first candle's close, signaling hesitation. The third candle is a long bearish candle that opens below the second candle's body and closes at least halfway down the first candle's body. This pattern strongly indicates a bearish reversal after a strong uptrend. The shooting star pattern occurs after an uptrend and is identified by a single candle with a small lower body, a long upper shadow, and little to no lower shadow. This pattern signifies that while the prices were driven up during the session, by the end, they fell to near their opening prices, suggesting a potential downtrend. In depicting these patterns on a chart without the use of images, imagine the price movement as a narrative. The candles in the deliberation pattern tell a story of rising bullish confidence that is suddenly met with doubt, symbolized by the shorter body or doji of the third candle. The evening star adds drama to this tale, with a gap and a decisive bearish response indicating a stronger likelihood of reversal. Meanwhile, the shooting star represents a failed attempt to continue the uptrend as sellers push the price back down, hinting at a changing tide. Traders interpret these patterns by considering them signals to potentially sell or to prepare for a downturn in a previously bullish market. However, it's crucial for traders to complement these patterns with other analysis methods to confirm the trend reversal and manage risks effectively.